countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Tuesday the 19th, 30 minutes to the close. What do you need to know out of Europe this hour? Well, let me tell you, Boris Johnson unveils his plan for Green Britain. But the Prime Minister tells Bloomberg that tough negotiations lie ahead if this month's COP summit in Glasgow is to deliver similar commitments from others. Russia says Europe won't get extra gas until it gives the green light to start supplies via Nord Stream 2. We'll discuss that in a moment. What does it tell us about the winter ahead? And from Ericsson to Danone, the warnings on supply chain shortages continue as the European earnings season rolls on. Equity markets, let's talk a little bit about where we are right now. We're bouncing off session lows. We are now up by 0.3%, 468, so nearly back into the 470s. The recovery has been fairly swift over the last few days. What is interesting is, Alex, despite those comments regarding Nord Stream 2, UK nat gas actually taking a little bit of a dip today.
Yeah, you have to wonder how much is baked in. Also, I guess it's going to get a little windy over there, so that might help you guys over in the UK. Here in the US, it is definitely an earnings-heavy story. On the downside to the S&P, you got the likes of Carnival, for example, Kroger, Cisco, as well as Procter & Gamble, down by 1.6%. You had organic sales coming in strong, but, I mean, they're dealing with higher input costs anywhere you slice it. Higher transportation expenses, unfavorable mix, increased commodity costs, packaging, and investment in product. I mean, that's a pretty big list of input costs that you have to handle. I do want to point out, we were just talking about, you have the Bitcoin Pro Shares ETF starting to trade. So I want to take a look at the actual futures contract, 62,000 up by 2%. So what kind of arb are we going to see from the futures? And then the ETF will be quite interesting. The curve steepening today, different than we've seen the last couple of days. You have a little bit of buying coming into the front end. Have we kind of overpriced maybe a more aggressive Fed? And the dollar also rolling over, helping to boost overall commodity prices. But in terms of energy, Guy, maybe a little bit of better weather, maybe, for you guys over in the UK.
It's going to be windy, and apparently it's going to be mild as well, which sounds like British weather kind of through and through, throwing a bit of drizzle. And
rain, I was going to say, got to be rain.
Yeah. Well, not really rain. I think drizzle kind of really sums it up. A bit of grey drizzle really kind of sets the tone here. Let's talk more about what's happening with the energy crisis here in Europe. As we were mentioning just a moment ago, Alex, Russia seeking swift approval for the Nord Stream 2 pipeline in return for sending extra gas to its European customers. Henry Mayer, Bloomberg's senior reporter on politics and international affairs, joining us now from Moscow. Henry, we've been waiting for this. Vladimir Putin said the other day that Europe could have whatever gas it wanted from Russia, but always there was going to be a kicker, and this is it. The Russians want Nord Stream 2. How is this going to work out?
Yeah. Well, I mean, you know, Putin finds himself in the enviable position of having something that Europe needs, and of course he's not going to lose the opportunity to get something in return, as you said. I mean, Nord Stream 2 has been a very, very difficult project. The American sanctions held it up for a long time. You know, now it's finally been constructed, but it's got to overcome these regulatory hurdles in Europe. And so the Russians are clearly putting, you know, the line down and saying, well, fine, you know, we're willing to help you in your hour of need, but, you know, you have to get this pipeline on stream.
Henry, and I wonder if it's not only the pipeline, it's also the type of contracts. The market's been transitioning very quickly towards a spot market, whereas you have the suppliers love those 10, 15, 20-year contracts because you're locking in money for a long period of time. And I wonder if that's also some leverage here that Russia will execute and have.
The Russians are definitely keen to reinstate the link to oil and in these long-term contracts move away from spot pricing, as you say. It's all a question of what's achievable. Certainly, I think their bottom line is they're not going to settle for anything less than approval for Nord Stream 2, and they will, of course, have other demands that they'll be pressing too.
Yeah. All right, Henry, thanks a lot. Really appreciate it. Bloomberg's Henry Mayer joining us there. And Guy, I feel like this sets the stage for what's going to happen over in the UK, well, in Scotland for COP26. I mean, how do you commit to certain goals when your power prices are surging at the end of the day?
Well, ultimately, a lot of these leaders answer to their constituents, don't they? And those constituents are now seeing their energy prices going higher. that is going to make it more complicated for these leaders to commit to some of these very ambitious targets that the British Prime Minister is talking about.
Yeah, exactly. And speaking of, good segue, Guy, the Prime Minister Boris Johnson did issue a call for real action on climate change ahead of COP26. Now, the UK is hosting the summit in Glasgow in just a few weeks. Prime Minister sat down exclusively with Bloomberg's editor-in-chief, John Micklethwaite.
I think COP was always going to be extremely tough. We're hoping that we'll get a good turnout in spite of the pandemic. What we want people to focus on is their nationally determined contributions in reducing their CO2, making those hard pledges. Plus, we want commitments on coal, cars, cash and trees. So we want the world to move away from coal by 2040, 2030 for the developed nations. We want to make sure that everybody stops using hydrocarbon-fueled internal combustion engine cars, and the UK is in the lead there. We said that we would stop that by 2030. We want a big package for the developing world to help countries that haven't been historic emitters to cut their carbon. So we need that $100 billion a year. We need that $100 billion. And the last thing is we want to make sure that we plant millions and millions of trees to help to fix the carbon and to restore the balance of nature. So those are the we need the nationally determined contribution. We need to keep 1.5 alive. We need to restrict the growth in temperatures to 1.5 degrees by the end of the century. We think that with the commitments that we're seeing, we could do it, but we're going to need to see some real action from the participants in Glasgow.
The British Prime Minister, Boris Johnson, speaking exclusively to the man standing next to me now, our editor-in-chief, John Micklethwaite. John, thanks for joining us.
Thank you.
The Prime Minister and his team are managing down expectations for what COP is going to deliver. What does success now look like, do you think, at this summit?
That's what I tried to ask him, and he didn't really reply. He says a bit about, I think it's coal, cars, whatever and whatever. And it's a bit like when you were talking about drizzle earlier on. There's a small element of that. But I don't think, I think fundamentally he wants to have some kind of deal coming out of this. And it's a kind of important time for Johnson. He's got his investment conference this week. He's got COP coming up. If he can show real sort of, it's putting Britain a bit back into the global picture. Global Britain becoming an issue again. They've had the
Green Britain, wasn't it? That was
global and green. These are both both things that he's trying to push. But I don't know. I think from his point of view, Britain strangely is actually relatively far ahead on quite a lot of these things to do with renewables and stuff like that. And there is sort of talk of bits of the kind of British high-tech manufacturing being very close to a lot of the green revolution. So in some way, it's not all kind of hot air, to use a familiar global warming term. There is real substance there, and a lot of the science has come from Britain as well.
John, you guys are having a really hard time there in terms of power prices. And I'm just wondering how the spin happens for Boris Johnson on that. How does he make the plea to other countries when in the meantime power prices are surging, there's an energy crisis because in some respects of this transition?
You're absolutely right, Alex. What the question you asked on the last one was absolutely right as well. It's about the sort of spot prices. There are these suppliers who are stuck trying, they've entered lots of long-term contracts with people and they're trying to supply them. So you've got an industry in crisis because they can't afford to pay the spot prices to get the fuel they need to pass on. The bigger problem, I think, and this is something which Britain could be the next case of, you could argue the Gilets jaunes in France was part one, is you look around the world, that there is a kind of beginning of a kind of middle-class resentment against global. Everyone's for fighting climate change until somebody asks them to do something really hard. And the classic case here is this instance of heat pumps. We're saying to people, you need to go and get a green heat pump to make housing greener, etc. But once people say those cost $5,000, people look utterly astounded. It's the same thing as in America or indeed France with the Gilets jaunes, where people say, yes, you want to go greener, but your petrol prices or gas prices are going to go up. And it's the same thing, and it's quite interesting, I think, in the same way as very few people, if you ask them about the idea of opening up economies and free trade, most people were pro that, but they were extremely anti it once it meant that their jobs got into question.
There was a briefing earlier on down in Westminster in which it was laid out that we are heading for a tough winter here in the UK, that COVID is going to be a problem. It already is a problem in some ways. We have elevated rates compared with our peer group. What does Boris Johnson need to do to get himself, the party, the popularity ratings through this winter?
I think the answer is, and the strange thing about Boris is you look at him and you would imagine that on the basis of the record so far, he'd be in some degree of trouble. Britain's had, I think, the second or third worst deaths per million people for COVID. You've got all the problems coming, COVID coming back. You've got the fuel crisis. You've got queues at Felixstowe. You've got this issue about taxes going back up. You've got the fuel crisis that Alex was doing. You know, the amazing thing is how well he's done so far. And a lot of it depends on, I went to the Tory party conference. There is a very interesting divergence between the apparent competence of the government and its poll ratings. And a lot of that has to do with choice. You know, if people don't entirely love the Tories and they're worried about how competent they are, but they don't yet trust Labour. And so that, I think, is probably his strongest thing. So I suspect you're going to see slightly more attacks on Labour. The other bit which came through that interview is I think Boris is slightly reconnecting with the people who actually contribute money to the UK economy. There's, you know, massive focus on things like fishing that generate just $800 million of money to the British economy on a yearly basis. Finance, the city, insurance, the stuff which is the business of Guy Johnson, they contribute $160 billion. And so, and by any measure, that's 160 times what fishing does. By most measures, Boris Johnson has probably spent 10 times as much time on fishing and squabbling with the French about that than opening up Europe to the city.
Yeah, keeping that wound open, though, certainly maybe helping him politically thus far. Maybe we'll have to come up with a new F for business.
Yes.
As we work our way through this winter.
He did actually use a rather unpleasant word about business in the Brexit campaign, but that was, we'll move over that.
Some people may have forgotten it, not everybody. John, thank you very much indeed. Bloomberg's editor-in-chief, John Micklethwaite. Alex. Yeah,
speaking of energy, I just want to get you these headlines here. So we reported earlier that China was looking at ways to help the coal price, and now they're taking aim to raise coal output to 12 million tons a day, and they're going to make coal transportation a priority at ports and railways. We already saw the coal price over in China come down as we were reporting that there was going to be intervention. It looks like this is part of it, raising coal output, making coal readily available. All right, coming up, you got European stocks. They are edging up today. Bank of America says there are more downside risks, though, ahead for European equities. The strategist who heads that team and who made that call joins us next, Sebastian Riedler. This is Bloomberg.
We see the same type of supply disturbances posing some threats to the fourth quarter, but I would still not exaggerate.
Chips and ships, the Ericsson CEO speaking to Bloomberg a little bit earlier on today on what is happening with the supply chain issues. We had the same message, maybe even a stronger message coming from Danone a little bit earlier on as well. They see issues lasting into next year. What does this mean for the European equity market outlook? We've had a great growth run. Are these supply chain issues now going to hit industrial Europe hard? Sebastian Riedler, Bank of America head of European equity strategy, joining us now fantastically on set. Great to see him in a tie. Great to see him on set. You remembered how to, yeah?
There was some difficulty involved, but I got it done at the end.
Okay, so there we are. I've got CEO after CEO, CFO after CFO talking to me about supply chain issues here in Europe. They're concerned about it. It's starting, particularly for the industrial companies, to have a meaningful impact. Is that a reason to avoid industrial Europe and favour services tech America?
My short answer is yes. These are the industrial stocks. They are very cyclical. They've benefited from the strongest growth rebound that we've seen in 20 years. Growth has peaked first in China in November, then in the US in May, now in the euro area in July. You're running out of the reopening boost, you're running out of the fiscal boost, and suddenly you have a lot of headwinds, the energy shock, the supply chains. You've got an intensifying debt crisis in China. It's very likely that growth will slow, and they will suffer if that happens.
So does that mean that the whole shift to value trade, which has really benefited European equities, is that something we should actively be trading against them?
So at the risk of sounding a bit complicated, I do think there's one last leg of value outperformance coming. Why? Because we have a very interesting feature in the markets at the moment, the decoupling between the rate cycle and the growth cycle. So growth is slowing, but the rates are still catching up. Bond yields are still coming up because they were so slow to respond to the rebound in the first place. And value is a trade on rates. So if we've got bond yields going up by another 20 to 30 basis points, then there's one last leg of value outperformance coming.
How big is that leg and how long does it last?
So we have another 3 months of upside of around 7 to 10% for value stocks.
Quite chunky then.
Yeah.
So there's still quite decent gains to be made, but risk reward in that?
I do think, no, it's balanced. I think it's okay. And the simple reason for this, think of all the recovery beneficiaries. The equity market up 70%, cyclicals versus defensives, the pure growth plays up 60%, value up 10%. It has lagged because rates have lagged. So if rates are now catching up, then there's more headwind, there's more headspace for the value trade.
So in that, what's the rotation?
That is effectively the rotation. It is financials still outperform. Yeah, you go.
I was going to say, okay, so you go with financials, maybe you go with energy for a little bit, and then where do you go? Do you have to go back to the U.S.? Do you go in cash? Do you go in treasuries?
I do think going into cash at the moment is very attractive. So as I said, there are still some pockets in the equity market that have catch-up potential, that haven't fully participated in this wonderful growth party that we've celebrated over the last 18 months. But if you look at the asset classes, credit spreads are already at a 15-year low. Equity markets are at an all-time high. Everything has benefited from the rebound, which has brought forward asset returns. So I do think as growth cools and there's some payback on asset prices, being in cash for a while is not a bad choice.
I read your fund managers survey today. Very different view. People are bailing out on bonds, but they're certainly not bailing out on their equity.
Correct. So I think the investors half agree with us, half disagree. They agree with us the growth cycle has peaked. And so the fundamental discussion that we have now, what is the main drive of equities? Our very simplistic proposition is equities follow the growth cycle. They have benefited tremendously from the upswing. What investors effectively are telling us, growth is going to slow, but there's not going to be a payback on equities. And we say, maybe that's a little bit too optimistic.
Interesting. So growth slows, there's going to be a payback in equities. I wonder what this means then, say, for energy, because part of the reason why energy prices are staying elevated is because we're not seeing the typical supply response to that exact point, because the overall feeling is that maybe demand won't be as strong in 2022. What do you do there?
So we're underweight the energy sector, and we would say, you say there's no supply response. My simple reply to that would be, look at the actual global oil output. It was 92 million barrels 6 months ago. It's now 97 million barrels. It's the sharpest 6-month increase in oil supplies that we've seen at any point over the last 10 years. Plus growth is slowing, plus the dollar is strengthening. That is not a good combination for the oil price. Our commodity analysts, they are more bullish. They say there might be a cold winter, so some demand coming over from gas. But I'm saying if supplies are rebounding, and you've got a strong dollar and weaker growth, that makes any oil price rally and therefore energy outperformance slightly less sustainable.
When you think about what happens over the next 6 months and you think that there could be a drawdown, how significant is that drawdown going to be? Because I hear what you're saying, and I understand we're going to get this growth momentum slow down. It's going to be interesting to see what the PMI say on Friday, and we'll get some more data on what is happening. But there's this wall of money over here, wall of money, bucket of money, huge bucket of money, sea of money over here, massive amounts of liquidity that is still looking for something to do. Credit looks, as you say, stretched. Bonds, people don't like those anymore. There is no alternative, so you go into equity. So how do you see the trajectory of a downturn being?
So I agree with you that the pullback in equity is likely going to be far less pronounced than the upswing. Just for reference, the market is up 70%. We expect a 10% pullback. So you're comfortably still in the money. And that's partly because we think growth is going to slow, but it's going to stay above trend. Remember, your starting point last year, which is what was such a fantastic starting point, because growth momentum was at an all-time low. So there was so much scope to rebound. But then to your question about liquidity, we try to be as scientific about it as possible. Say, what typically guides equity price? If you look at the historical data, and there's one clear answer, it's growth momentum. So regardless of the amount of liquidity, reliably, when growth momentum slows, there is a price to be paid for equities.
So what's your base case then for what the ECB does? Because that puts them in a really tricky scenario, right? Like growth is above trend, but growth is slowing. And then how does that kind of inform an equity view?
So I would say central bank policy is the second most important driver. So we talked about the importance of growth momentum. The second most important driver is central bank policy because it drives real bond yields. And you can think about those as the discount rate for equities. And what has happened since March last year is real bond yields dropped by 200 basis points. So you were in a phenomenal Goldilocks environment. Your growth momentum goes to a 15-year high. Your discount rate goes to an all-time low. If you look at your discounted cash flow model, that's just perfect. So what you have now not only is growth slowing, but because it stays above trend, central banks are moving towards tightening. That means higher real bond yields. And suddenly you switch from a Goldilocks environment, accelerating growth, lower discount rate, to an anti-Goldilocks environment. So I would agree with you that central banks becoming more hawkish is a second negative headwind for equities.
There's one central bank that may not be becoming more hawkish, and that's the PBOC. There's a lot of talk that the PBOC is getting ready, maybe not imminently, but in the medium term, to slash rates. 50 basis points is talked about quite a lot. If we were to see China taking remedial action on the monetary front, how would that affect the European outlook?
I think it's a great question. And the first implication is a stronger dollar. Because if the Fed is tightening and the Fed is furthest advanced in the tightening cycle, the PBOC is cutting rates, and I think they will have to. They will have to cut the prime rate. They will have to cut the reserve requirement ratio. Suddenly, you've got one central bank hiking, the other one easing. Remember, the renminbi has actually recently strengthened against the dollar. So we are positioned for a stronger dollar. That is some headwind for commodity prices. It's also a headwind for US-focused defensive sectors like pharma, and because we think the dollar will strengthen partly because of that PBOC policy response, you basically have to be positioned, I think, for more dollar strength.
And then before we wrap up really quickly, what happens with the UK? I mean, you talk about hawkish versus dovish central banks. I mean, that just brings me right to the BOE, the hawkish of them all, it feels.
That is true, and our economists are slightly worried that you will get a sharp slowdown in the UK next year, partly because you're already getting the hit on consumers' purchasing power, plus the central bank is tightening, plus you've got worse supply chain issues than in other European countries. So that means scope for UK growth to slow. How do you position for it? Be underweight UK domestics relative to exporters, and we think that's a nice position to hold at the moment.
Love to get the counterintuitive view. Sebastian, thanks a lot. We really appreciate it. Really great to see you in the studio, Sebastian Radler of Bank of America. Thank you very much. This is Bloomberg.
From London, I'm Guy Johnson. Alex Steele, of course, over in New York. This is the European close on Bloomberg Markets. We are counting you down to that close. 4 minutes until the end of regular trading here in Europe. We're off our lows. We've got some of the main markets in positive territory. The French market actually is where I think the action is today, because Danone's numbers really have had a meaningful impact today. So the CAC being dragged down by Danone, but it's rippled into other areas as well. For instance, Nestle very much coming under pressure as well. What are we going to talk about next? We're going to talk about this, and we're going to talk about the future of the 60-40 portfolio. That's something that we're going to be talking to Howard Marks, Oaktree Capital's co-chair and co-founder, from Milken next. So we're wrapping up the Tuesday session here in Europe. To be honest, it looks like there's not much price action going on here. We are off our lows, though, and to be honest, it could be worse. It could be 1987. The FTSE is up by 0.2%. The DAX is up by 0.3%. The CAC is being held back by Danone. It is absolutely flat. But we are, and you have to kind of take a step back. I say this every day. We are very close to record highs. Even here in Europe, we are still very close to record highs. Let's show you where the Stock 600 is. The Stock 600 is kind of reapproaching the 270 level. The 470 level. We're at 468, spot 82. We're up by another 0.4%, pushing up at the end of the session. Remember, we got kind of into the 475 area before we had quite a decent downdraft. But maybe, as we were hearing earlier on, maybe the recent lows are in. Though Sebastian Radler noting caution here in Europe. Let's talk a little bit about where we are for the sector story, because, again, I think this is important. The earnings season is having an effect here. This is earning versus inflation debate that is taking place. Food and beverage right down here at the bottom. That's Danone. The Danone numbers today, the supply chain story, everything coming together really to knock that entire sector. And it's rippled into other areas of that same space. So food and beverage is down Danone ripples into Nestle. Nestle's a hugely heavyweight company, they all are, and they're dragging everything down. Utilities are up, media is up, financial services is up, technology is up. Feels a little defensive, doesn't it? Because also on the downside, what have you got? Telecoms, the car sector's in there as well, some of the chemicals, some of the banks as well, also not sort of driving huge performances today. So there's Danone, down by 3.16. The ripple effect from what it had to say. The French yogurt maker, I remember in the days of my youth talking about this being a strategic asset for the French. Today doesn't certainly feel like it from a market point of view. Ericsson down by 3.73% as well. Again, chips and ships. The supply chain shortage story absolutely front and centre. And then IAG down as well. A little bit of good news and a little bit of bad news. IAG, I think, is probably down on a number of different reasons, but one of them is that Heathrow is going to be putting up charges. They're not as much as they would have wanted to, Heathrow that is, but still charges are going to go up, which is going to be another cost on an industry that is still struggling to recover. November the 8th is going to be a huge day for IAG and other airlines as we reopen the North Atlantic. For me, to come and see you, Alex.
Yes, waiting for it. Also, so nostalgic today, really digging into the 80s. Okay, let's go back to the Milken Institute Global Conference right now. It's underway in Los Angeles. Howard Marks, Oaktree Capital co-chairman and co-founders, on with a panel with Bloomberg's Romaine Bostick.
I think we would be in a serious global depression right now.
There are a lot of people who agree that what they did was certainly right. There's a lot of disagreement about how long they've kept some of these measures in place. Have we reckoned with the ramifications of keeping this stimulus out there too long?
Yes. Well, you know, most people, if they were knowledgeable and if a vote were held, would prefer low interest rates to high. You know, business does better. People can buy stuff cheaper. Rates on mortgages go down. Politicians can spend more money. The Treasury has less trouble paying the debt service. All these people want low rates. The only thing is, it's low rates is kind of like ice cream. Is such a thing as having too much, so you know. Not too many people want to see high rates, but if we keep rates artificially low, then perhaps we overstimulate, perhaps we have inflation, perhaps the dollar weakens, perhaps the dollar loses its role as the global reserve currency. So there has to be a balance.
You've invested through quite a few market cycles,
yes.
Quite a few economic cycles. Is the one that we're in right now, does that make your job or the job you used to have more difficult or easier?
It's tough at the time. We're in an unusual circumstance. First of all, the cycle we've gone through in the last 18 months of the pandemic was not really a normal cycle. Normal cycles, in my opinion, are the result of people becoming too optimistic and overshooting intrinsic value, fair value, and then a correction toward fair value, but it carries through to underpriced, and then people get too pessimistic, and then a correction back toward fair value, but it overshoots and heads to excessive. So excess and correction is the normal source of a cycle. This cycle had nothing to do with the economy. This was like a meteor hitting the Earth from outer space. It was an exogenous event, the pandemic, and then the government Fed policies undertaken to correct it. So I saw a pandemic, an epidemiologist from Harvard at the very beginning of the pandemic, and he said we have three things. We have facts, analogies to prior experience, and supposition. But in the case of the pandemic, there are no facts, there are no prior experiences. We have only supposition. And I think that's where we have been. So that has made life tough.
Right. Well, then, and as an investor, how do you determine intrinsic value? How do you determine value at all?
Well, you try to figure out what the cash flows will be. You discount those back to the present at a fair discount rate. You apply windage for uncertainty, et cetera. That's what you normally do. Normally do. But of course, first of all, we have the lowest interest rates in history. Which, if something grows faster than the discount rate, then in theory it's worth infinity. So it's hard to operate in a world where things are worth infinity. And by the way, there are people who are willing to pay infinity for them.
We've seen that.
Makes it hard on a value investor. And then, of course, since it's not a normally occurring economic cycle, it's harder to get your hands on it. Normally, when we're at the beginning of an economic upcycle and we're only a year in, you're usually pretty low in terms of the market. Now we have a market which is high, and the economy is getting going. So, I say in the first year of the recovery is getting going. But you could say, well, the bad news is that the economy hasn't done much and stocks are highly valued already. Or you could say the good news is that stocks are highly valued, but the economic recovery lies ahead. And, you know, investing is full of on the one hand and on the other hand, and I think this is a great example.
But those valuations have not only caused people to question the current state of capital markets, but to seek out maybe risky alternative things that maybe are a little bit harder to pin value on. Cryptocurrencies, for example, something that you yourself said at one point was basically worthless.
Yes.
You still don't feel that way.
Well, you know, I put out a memo in January called Something of Value, in which I said I thought that my reaction to Bitcoin in 2017, which was the year that it exploded from 1,000 to 20,000, that my reaction was a knee-jerk, skeptical reaction to something new because of its newness. You know, my son and I lived together during the pandemic, and he gave me a lecture every day on the fact that I had opined about Bitcoin without knowing what I was talking about, which is certainly true. You know, we have the lowest prospective returns in history, and my typical client, a pension fund, an endowment, for example, needs about 7% a year return to make the math work. And most people have accepted that you can't make 7% today safely and dependably, and certainly not from stocks and bonds, developed world stocks and bonds.
Right.
So that means you have to go push out the risk curve and go further afield, into new things or odd things or something like that. You have to take, you know, you have to go into, let's say, maybe private equity and take on the risk of being levered, or you have to invest in assets which are illiquid in nature. So, you know,
what about real estate?
Real estate's another example. I mean, now, investing is always a place where the things that everybody likes and feels good about are highly priced relative to the things that people have trouble with. So, you know, everybody says, oh, you know, logistics and data centers, great, okay. I don't think you can buy them cheap. You know, it's counterintuitive that everybody could agree that an asset is great, but it's a bargain. On the other hand, everybody says, well, you know, brick and mortar retail, I don't know about that, and office buildings in coastal cities, I don't know about that. So if people are skeptical, then that creates the possibility that these things can be bought cheap. But still, you need subject matter expertise. You know, one of the great messages of that memo about my time with my son was that if you can't look at something superficially from the outside, from a high level, and opine on its fairness. You know, he says, you know, the S&P at that time was selling at around 24 times coming earnings, and you know, historically, one would look at that and say, well, that, you know, the post-war average is 16, 24, 50% higher than that. That's an extremely high valuation. But what he says is, number one, you have to be conscious of the fact that the composition of the S&P has changed. It's now 27% information technology, and in general technology, much more than 27. That's something new.
Right.
And in order to be able to look at it, you have to understand the tech stocks and you have to conclude that they're overvalued. And to do that, you need expertise.
Has risk become too concentrated?
I don't think it's become too concentrated. I think it's become too warmly embraced. As I say, people, what people are saying is, if I can't get the return I need safely, I'm going to try to get it unsafely. Well, that introduces some concerns for the whole investment environment.
When you have a market that is distorted, say overheated,
Yes.
like a lot of people would say the current markets are now, how would your firm, how would Oaktree either position themselves or exploit that situation or protect themselves?
People in the media have,
Like me.
you. I wasn't going to say that.
That's fine.
But people in the media try to get you to say buy or sell, in or out, risk on, risk off. And I've stopped doing that in the last 5 or so years. And the way I think about things now is, what is your normal position in terms of risk, given your age, resources, needs, dependence, plans, intestinal fortitude, etc.? What is the right risk posture for you? Where should we be today relative to that normal risk posture? And I would say for Oaktree, we're at normal today. I don't think it's time to be much more aggressive than normal, but I have trouble going strongly on the defensive when I think the economic outlook is still good. So I would say normal.
How much does duration factor in to your strategy? Right?
Well, duration is a consideration for the straight fixed income world, because the volatility of a security, the responsiveness of a security to changes in interest rates is a function of its duration. But we don't care about that, because we're not classical bond investors.
When you look at, I guess, the overall economic picture, some of the improvements that have been made in our economy here in the U.S. as well as globally, and you go back 40, 50 years ago when you were starting, what are the improvements that you've seen?
Well, clearly, the events of last year, to the extent that they're indicative, showed that we've learned how to fight recessions, and we used to have recessions that really kind of got out of control and went on for a long time. In the global financial crisis of 2008, post the Lehman bankruptcy, the government figured out some things, ranging from quantitative easing to guaranteeing commercial paper, et cetera. And those things worked. They took them some months to do, but they worked. They applied those lessons last year in the pandemic in days or weeks, and they worked enormously. So that's an example. And of course, on the other hand, one of the great trends of the last 50 years is that most markets have become more efficient. Buffett used to talk about buying dollars for 50 cents routinely. It's hard to do when there are a lot of other intelligent people looking for the same 50-cent dollars. And they all have good eyesight, and they're all highly motivated, which is where we are today. So it's gotten harder to beat most markets.
Is that efficiency? Is that good for the market overall? I know for investors that's not always good.
Well, in theory, efficiency is good for the market because it helps companies raise capital at a fair cost, and it helps people invest at a fair return. But of course, people in my position are not looking for a fair return. We're looking for a return that's more than fair. What the academic would call an excess return. That's why we exist. If you're willing to take an average deal, you don't need us.
No.
Investing, it's really easy to be average, and it's quite hard to be above average, and it's gotten harder. And the measure of superiority has shrunk over time. That's efficiency.
Right, and where you benefited and where a lot of investors of your generation benefited was there seemed to be a little bit more randomness to the market. There seemed to be a little bit more asymmetry in the market that can be exploited. If we're at a stage now where everyone knows everything.
Well, I mean, when the markets become more efficient, it becomes harder to outperform. And that's where we are. You know, I look at high yield bonds. I was in with Mike at the beginning of the high yield bond world. I met Michael in November of 1978. The high yield bond world started in 77 or 78. And I could put together portfolios that would have higher returns with lower risk. Then the market got a little more efficient. And then you had, if you wanted, it was a great achievement to have a portfolio with a higher return with the same risk. When the market becomes more efficient, portfolios that have higher returns generally have higher risks. So the world becomes less attractive from the point of view of a bargain hunter. Today, or in recent days, I would say that the best inefficiencies have come cyclically, not secularly, but cyclically. And you know, there have been 3, 4, 5, 6 occasions in the last 25 years when at least the potential was there to add value by timing the market right and knowing when we were at extremes.
With regards to the structure of investment firms and asset management firms, how important today is scale, size?
On the one hand, having a bigger asset total permits you to have more staff, in theory, more expertise. On the other hand, it reduces your flexibility and your selectivity. And you know, the truth about the investment business is that good performance brings more money. At some point, more money brings bad performance. So the goal is to arrest that process before you have too much money. Now, there's no way to tell in advance where's too much money. You know, if you and I worked for Firestone and we developed a new tire and we said, well, how far will that run, Romaine? You'd say, well, let's put it on a car and find out. And you run it until it blows up. We don't have that luxury. We can't expand our assets until our performance blows up. So by definition, we have to stop this side of the wall, which means we never really find out where the wall is. But I think that limiting your assets is important. And I think about our industry as ranging from artisans to factories. The artisans have less assets, but you know, do a more labor-intensive job, and the ones with skill have better performance. The factories may competently manage vast sums at low cost, but are unlikely to have great performance.
But we've seen consolidation in this industry, particularly among some of the artisans and the factories.
Yes.
You yourself partnered with Brookfield, Oaktree. What was the impetus behind that? Why?
What?
What was the reason behind the partnership with Brookfield?
Well, mainly, I mean, Brookfield initiated it because they wanted to be in the credit business. And if you look at their asset classes, which are private equity, real estate, renewable energy, they wanted to be in credit, and they figured it would take them a long time to build a credit operation, and it may not end up as what Oaktree is, so why not buy Oaktree? And so they bought 60%, the public owned 50%, they bought that out, they bought 10 from us, and that settled in the fall of 19, and then and they'll, you know, we have the option to put our remaining 40% to them over time.
And then they retained your expertise, though.
And they retained our expertise.
And that seemed like a testament to how hard it is to build that type of business.
Yeah, I think so. I mean, in this case, they concluded that it was better to buy it than make it, and I think that made some sense.
I want to pivot here, Howard, to some of the discussions that we've been having in the pandemic about diversity and inclusion.
Yeah.
You, Oaktree, Ares, Apollo, recently started an initiative, $90 million being pledged to HBCUs, but it's specifically targeted at trying to find people to move into the alternative investment world.
Right, right.
Why?
Well, look, first of all, organizations like Oaktree and the ones you name, I think have been concerned with diversity for years, doing something about it for maybe years. But, for some reason, the events of 2020 got everybody to kind of turn up the heat. Maybe it was being home and watching more TV. Maybe it was the starkness of the Floyd murder. But that struck a responsive chord that hadn't really been struck before. We all knew that that representation of women and underrepresented folks was disappointingly low, but kind of for some reason 2020 is the year people decide to do something about it. And so Ares, Apollo, and we got together and we formed this thing called Alt Finance. And by the way, if you look at the numbers of the investing industry overall, I think they're much better than the numbers for the alternative investment world.
Oh, yeah. Well, I mean, you walk onto an equity division, it's a lot of diverse faces,
Right.
fixed income.
Exactly. So, it takes time for the people who don't transition as easily to find the new thing. Alternative investing is a pretty new thing. I don't think the word existed 20 years ago. We just got, we and Apollo and KKR and Ares and Blackstone got lucky because the world turned out to need the solutions that we offer. And but as I say, it's a rather new development, and people haven't gotten to us yet, and we're highly selective. And the challenges of, well, everybody I know who's done it is a man or is a white man. They make life tough, and you have to break through that. So we're trying to break through that. We're trying to raise awareness of the alternative investment world on the campuses of historically black colleges and universities, and then provide curriculum. And we're developing a curriculum in partnership with Wharton, and provide fellowship money so that people can afford to go to school and deal with emergencies that arise, and provide internships. So we're looking at a 360 package that should, over time, raise the representation of the underrepresented in the alternatives industry. That's our goal. And of course, in so doing, attract desirable staff members ourselves.
Of course. And of course, this comes at a time when alternative investing isn't the niche that it once was. I mean, everyone seems to be hanging out in an alternative investment banner of some sort or another.
Well, it's not the niche it used to be in terms of, if you went back 40 years ago, you would say, well, I have 60% in U.S. stocks, 32% in U.S. bonds, 3% in emerging markets, 1% in private equity, 1% in an index fund, and 1% in hedge funds. That was, those things were just kind of exotica that were in there for spice. If you were in the 90s and the S&P was appreciating at 20% a year, as it did, you didn't need that other stuff. Today, you need it. So, today, that stuff is not considered exotica. It's mainstream. And today, there are trillions in those fields. So, on the one hand, it's gotten harder to steal stuff. It's gotten harder to find real bargains, glaring bargains. On the other hand, it's a much bigger industry. We can hire and employ many, many more people, and we want to increase the representativeness of that population. And I think that Ares and Apollo and Oaktree went into Alt Finance because
Howard Marks, Oaktree Capital co-chair, co-founder, sitting down with Bloomberg's Romaine Bostick. You want to carry on following what is being said in this panel at the Milken Institute Global Conference? You can do so on Live Go. There's another way of following it as well, TLIV. There's a top live running right now on the conversations that are being had out there in LA. Alex, a couple of things have happened. First of all, I think next time they hold this, I think we should be hearing from Howard Marks' son, who apparently has been setting him straight on a number of different events, particularly when it comes to Bitcoin. So I think next time we need Howard Marks' son. We've also started, as we've been listening to that, to get some numbers out of Europe. Kering, Gucci numbers, comparable sales up 3.8%. The estimate was 9.3. That's a significant underperformance versus LVMH.
Yep, especially, yeah, exactly. LVMH was so solid. That wraps it up for me and Guy here on television. Coming up, an exclusive interview with Albert Bourla, Pfizer chairman and CEO on Balance of Power with David Weston. This is Bloomberg.